Now, when it comes to investing, I really believe one of the biggest decisions that you have that you can make is how is your account going to be treated from a tax standpoint. You know, we've been helping individuals in our office for many, many years, and one of the things that we found is that more often than not, individuals will underestimate the impact of taxes on their investments. Now, everybody has a choice to make. When you invest money in some sort of a retirement or investment account, moving forward, the government's going to treat that money one of three ways. It's either going to be in a taxable environment, a tax-deferred environment, or a tax-free environment. And to illustrate the differences, I want to walk you through a real quick example of growing money each of these three different ways. And we'll use a real simple example. Let's say that we took $1, and let's assume that hypothetically we could double the value of the dollar every single year over a 20-year period. If we're growing that money in a tax-free environment, then that dollar at the end of the 20 years is going to be worth just over $1 million. So again, if you double it every year for 20 years in a tax-free environment, you should have just over $1 million. Now, what happens to the same dollar if we put it into a taxable environment? Like many of our viewers right now, you may have some money invested in a taxable mutual fund or taxable savings account or stock account, something of that nature. Now, again, in this example, we're going to double the money every single year for 20 years, but because it's in a taxable environment, we're going to have to pay some taxes on the growth out of the account each year. And we'll assume that you're in a 28% tax bracket because that's the national average for taxpayers. At the end of the 20 years, if we're doubling the dollar every year in a taxable environment, instead of over $1 million, we're going to be left with just $57,000 at the end of this 20-year period. Basically, what happens here is the taxes that you have to pay along the way, that they're robbing you of the compounding interest. You didn't have as much money in the account every year for the 20 years to double. That's why you're left with a lot less. Now, the third way we could grow the dollar, of course, is in a tax-deferred environment. And the way that would work is we put $1 into a tax-deferred account, and it doubled every year for 20 years. At the end of the 20 years, we'll have over $1 million, right? Just like the tax-free account, but we'll have it still in the account. If we want to take it out of the account, we're going to have to pay some taxes on it. When we do that, after paying the tax bill, we would probably be left with around $600,000. Maybe a little more, maybe a little less. So growing your money tax-deferred is obviously a lot better than taxable, but still isn't nearly as good as growing your money tax-free. So, and really what we're talking about here is it's really not how much you have when you go into retirement, but how much you get to keep after paying your taxes. So some tax-free options that you would have available to you that you should really use. If you're like most individuals right now, and you have the majority of your money in either taxable accounts or tax-deferred accounts like IRAs or 401ks, 403bs, you want to start putting future contributions in most cases, or maybe doing some conversions with as many dollars as you possibly can over into the tax-free environment. It's going to have a dramatic impact on how much money you can spend and enjoy as you go into retirement. So some tax-free options that you have available right now, of course, most will have a Roth IRA that they can contribute to. Now, there are some income limitations, meaning if you make too much money or no money at all, then you cannot use a Roth IRA. But for most of our viewers watching right now, Roth IRA will still be a viable option. You can use that for both yourself and your spouse. So if you're under age 50, you can put $5,500 per year into the plan. Over age 50, you can put up to $6,500 per year into the plan, and that's for each individual. So a couple could, if you're over age 50, you could put as much as $13,000 a year into the Roth IRA. That money will then, of course, grow tax-free moving forward. If you're not eligible for the Roth, or you've already contributed to the Roth and you would like to save even more money, then certain municipal bonds might be a good option. Here there are no income limitations. There are no contribution limits, so you can put as much money as you want to into a municipal bond. Different municipal bonds have different degrees of safety. So before investing in a municipal bond, you want to make sure that it's going to be a revenue-backed bond or has some sort of guaranteed protection, something of that nature, but may be a very nice option for some. And then certain insurance strategies are available where you can put money into different types of plans. That money will grow tax-free, and you can take the money out tax-free. Again, not everybody will qualify for those plans, so you have to work with an advisor to see which option would work best for you. One area that I always encourage individuals to inquire about is if you have a Roth 401k option through your employer. This is what we have at our company, Strategic Wealth Designers, that a lot of our employees participate in, and that's a Roth 401k. So it works just like your traditional 401k, but obviously you're going to be putting money into it after tax, but then the money that goes into the Roth portion is going to grow tax-free. When you retire, you can take the money out and not owe any additional taxes on that. What's really nice here is there are no income limitations for the Roth 401k, so no matter how much money you make. There's no limitations like you have with the Roth IRA. And then obviously the contribution limits are going to be much, much higher on a 401k. So some of our viewers watching right now could put about $20,000 into their Roth 401k. So obviously a much larger contribution than what's available through the Roth IRA. If you have a Roth 401k through your employer and you're not currently utilizing it, in a lot of cases we'll recommend that you make that change. Go ahead and make future contributions towards the Roth portion so you'll have at least some money that you'll be able to access once you go into retirement completely tax-free. But again, like we mentioned earlier, this is probably one of the biggest decisions that individuals have that they need to make. You know, whether you get a little higher rate of return or can cut your fees a little bit, all those things add up and matter, but they'll really pale in comparison as far as how much you're going to owe in taxes in the future. That's really the biggest decision that you really need to be focusing on. So if you have questions or you're not sure what the best direction is to go in order to grow your money in a tax-free environment, then feel free to give us a call at the office, or as always, you can get more information from our website.